read financial statements. Now, this is a very in-depth topic that has a lot of details to it, so I am just going to scratch the surface and cover the summaries here. So, financial statements, the ones that we are going to look at are the balance sheet, the income statement, and the cash flows. These can be found on the quarterly and annual reports, the 10K and the 10Q, like we talked about in another lesson. The first one that we're going to look at today is the income statement. The income statement represents a company's performance over a period of time. It has a start and an end, and we're measuring the performance of how they did in between that time period. The specific performance we're measuring is how much money came in and how much money they were left with at the end of that time period. How much they made and how much came in. Not necessarily all of where it went, but how much came in and how much they actually net profited. So, the sections of the income statement that we're going to look at, and these come in order and they make a lot of sense. The first one is revenue. Revenue refers to how much money you actually brought in. Cost of goods sold is how much money you spent to produce the product that you sold. So if you are Tesla and you produce a car, your cost of goods sold represents the materials and the labor that goes into making that car. It does not represent your corporate office and your CEO salary and your email subscriptions. Next step after that is your gross profit. So your revenue minus your cost of goods sold gives you your gross profit. Your gross profit from there is subtracted by the operating expenses. This is where your CEO salary and your corporate office comes in. So you've got your gross profit minus your operating expenses gives you your EBITDA. EBITDA is a very common term. It refers to earnings before interest, taxes, depreciation, and amortization. It's basically, here's how much money you made before a couple of different accounting changes and you pay taxes. And then at the very bottom of the sheet is net profit, and that's how much the company actually brought in at the end of that time period. So how much money the company did in revenue, and then how much they're actually left with to put on the profit line at the end of that time period. That's what we're looking at here. So the company that we're going to use in this video as an example is Apple, because everybody's familiar with them, they understand the product, and they have fairly simple financials, surprisingly. So this is pulled from their last reported financial statements. Now, I do believe that they report pretty soon here, but this was from the last one that I could find. So if we walk through this right now, top to bottom, we see net sales. That's your revenue. That's how much money they brought in. $79 billion from products, $12 billion from services, total of $91 billion from the 3 months, the 3-month period that ended December 28th, 2019. Compared to the year before that, they increased it by 8 or 9% comparatively. If we go down this sheet, you can see cost of sales. That's your cost of goods sold. That's how much it cost them to make the iPhone. So products and services, you can see the exact same amount. Their gross margin here was $35 billion. So they brought in $91 billion. It cost them $56 billion to produce those products. They're left with $35 billion. Their operating expenses in here. So their corporate headquarters, their CEO salary, their overhead, their basically overarching business operation expenses that they have to pay no matter what are in here at $9 billion. They have their operating income. And at the very bottom here, you can see their net income. So they brought in 91 and they were left with $22 billion at the end of this basically time period. Earnings before provisions for income taxes is what they refer to as EBITDA. You'll see it change some of these terminologies on different financial statements, but this is basically the summary. So when we look at this, we're saying, okay, they brought in 91.8 billion. It cost them $56 billion. They were left with $35. They spent $9 billion on their operating expenses. Their earnings before interest, taxes, depreciation, and amortization were $25 billion. They refer to it as a slightly different term here. And after those taxing and accounting changes, they were left with $22 billion that went into their retained earnings. That is really important. That's how you read this income statement, and then you can start to do your math based on it. So that's the first one. That's how you read the income statement. The next financial statement that we're going to look at is the balance sheet. The balance sheet is different than the income statement. The income statement happened over a period of time. The balance sheet is a snapshot. It's like taking a photo of here's the company on this specific day. It always happens at the end of the quarter. So if we're reporting on Q3, it's the last day of Q3. This is the snapshot of the company, and this is exactly what it looks like. And what we're looking at when we take this snapshot of the company and take this report on the balance sheet is we're looking at how many assets and liabilities the company has. In other terms, how much money the company actually has, how much the company has, and then on the other side of it is how much the company owes. Who do we owe money to, and what is the debt on the company? These two categories are broken into long-term and short-term. Now, we're going to go into a very basic intro-level accounting principle, but it's really important that you know this, you recognize it, and you start to identify the different pieces that are at play when you read this balance sheet, because it's very important. So every balance sheet is structured like this. Assets equals liabilities and shareholders' equity. Assets are things that the company owns, like cash, inventory, equipment, property, investments, and accounts receivable. So if somebody gives us money for an order or places an order with us, that's an asset. Same thing with the cash, same thing with the physical properties. The liabilities are things like accounts payable and debt. These are the things where the company owes money. And then on top of that, shareholders' equity comes from the sale of stock and retained earnings. So the idea here is that your assets has to equal your liabilities and your shareholders' equity. So imagine you were just starting out a company and you wanted to purchase a piece of equipment to manufacture your widget. You go out and you buy a machine on net 30. Okay, so now you have an asset. Your assets has increased in the company, but you now have an account payable and you owe somebody else some money. So you've made a transaction where you've purchased this equipment, and the key to this transaction is your assets have to equal your liabilities and your shareholders' equity. So when your assets go up and you increase your equipment, you also increase your accounts payable. So the idea here is anytime you make a transaction, there's always two sides of it, and you have to always make sure that your company, the assets equal the liabilities and the shareholders' equity, and that's how you can determine the breakdown and the makeup of the company. Now we're going to look at the actual financial sheet, and I'm going to show you exactly what I mean. This is Apple, the exact same financial statement as the last one we looked at. And if you look at it, we've got three different categories here: assets, liabilities, and shareholders' equity. I'm going to run through it real quick and then go into detail. But if we look at assets, we can see the total assets for this year is $340 billion. If we look at the liabilities and shareholders' equity, we can see current liabilities, non-current liabilities, and this line right here, total liabilities of $251 billion. We can also see total shareholders' equity of $89 billion. And when you add up liabilities and shareholders' equity, it equals $340 billion, the exact same amount that the assets equal on the Apple balance sheet. So the principle here is that your assets always have to equal your liabilities and your shareholders' equity. That's how a balance sheet is structured. And the reason it's structured like that is your assets are what the company owns. The liabilities are how they got there, and the shareholders' equity is basically, did you raise any of that money to get your assets by selling your stock? So let's go through this. When we look at the assets, the first things on here are cash, marketable securities, accounts receivable, and inventories. The exact same things we talked about in the last slide. This is basically everything the company owns. Now, the difference between current and non-current assets is usually determined by a period of 1 year. If that asset is going to be turned over or used or is liquidated or is changed within 1 year, it's generally considered a current asset. If it's a piece of property that you plan to hold for 20 years, like the Apple headquarters, that is a non-current asset. And that's the difference. The same thing with liabilities. If it's a liability that's due within 1 year, it's considered a current liability. If it's due later than 1 year, it's considered a long-term liability. So as we go down, you can see inventories, other current assets here at $12 billion, total current assets of $163 billion. You can also see property, plant, and equipment, so all the buildings they own and all their securities that they own, maybe investments in other companies. And their total assets are $340 billion, and that's basically what Apple owns as a snapshot of the company at that exact period of time. Everything the company owns is basically on this list in here somewhere. They own $340 billion worth of assets. Now, they owe, they owe everything underneath this here. So their current liabilities, everything that they owe within 1 year, you can see their accounts payable is $45 billion, so fairly substantial. They also have other current liabilities of $36 billion. They've got some liabilities in here, up to $102 billion that are due within the next year, and they have another $148 billion that are due within the next maybe 5, 10, 15 years. This term debt here and other long-term liabilities, this is basically long-term debt that they're paying down on a yearly basis. And you can see that equals $251 billion. So they have $340 billion worth of assets. They manage that by getting $251 billion worth of debt. And they also have down here, you can see total shareholders equity of common stock, $45 billion, and retained earnings of $43 billion. So you can see here that most of their money came from basically debt and liabilities, but almost half of it, just under half of it, came from equity, such as the retained earnings that we saw on the last income statement. That net profit, that's your retained earnings, and that goes right into this balance sheet here. And when you sell your stock in return for money to be used in the company, that hits the balance sheet here. And that's what those two things on the bottom here are. The 45 billion and the 43 billion are basically Apple selling stock, as well as retained earnings from the company operating and basically using that money to generate more assets. And that's how you read a balance sheet. Here's what the company has, here's who they owe, here's how they raised money by selling stock, and here's how much money the company has profited and kept in the bank account. That's what you're looking at when you see a balance sheet like this. The last one that we're going to cover is the cash flow. The idea here is you're looking at the starting cash and the ending cash and what happened in between there, the cash in and the cash out for the company. And it's broken down into three sections: the operating, the investing, and the financing sections of the cash flow statement. So when we look at this, this is the exact same document from Apple. This is the cash flow statement from the same time period. You can see at the top here, we have their operating activities. Net income, the same number pulled from the income statement. This is how much money they basically made. And then this is what they did with all of that money. You can see cash generated by operating activities. They generated $30 billion within that quarter. You can see that they invested it in a number of different ways: non-marketable securities, purchase of different securities, sales of marketable securities, payments for acquisition of property, plant, and equipment. So they're basically paying out their leases in these different areas here. And then in the financing activities, this is something really unique about Apple that I just want to point out: repurchase of common stock. So this company is actively buying. In the last quarter, they bought back $20 billion worth of their own common shares to basically raise the price of their common shares. So something really unique, and just a quick glance of looking at the cash flow statement is where you can see that type of information. They also had to pay taxes, proceeds from issuing stock. There's a bunch of different things in here, but this is basically what happened to the money through operations. Where did you spend it to invest into the company, and how did you finance those operations and investments? That's what you're looking at in the cash flow statement. And the big glaring thing here when we look at Apple on the first glance is $20 billion right into basically buying back their own stocks, almost as much as their net income for the same quarter. So pretty drastic, pretty interesting when we look at the cash flow statement. But the idea here is this is where you look to figure out what happened to the money in between those 3 months, because you're not always going to find it on the income statement. And the reason is because, for instance, if Apple purchases an asset, Apple purchases a brand new piece of equipment that costs $20 billion, that is not an expense for Apple that is going to hit their income statement. That is the purchase of an asset that is going to be on their balance sheet and their cash flow statement, because that is an asset they are buying, and you are not going to see the purchase of an asset on the income statement, which is why you cannot rely on just the income statement. You need to be able to look at and understand all three of these financial statements. The income statement shows you how much money they brought in and how much they were left over with. The balance sheet is a snapshot of exactly what the company owns and what money they owe different vendors, as well as how they raised that money to produce the assets. And the cash flow is about what happened within that 3-month time period with all of the money that they had. So that's the quick summary on the cash flow statement. Another couple quick things: income statement shows profitability, balance sheet is a snapshot of the company, and cash flows show what the company is doing with that. So pretty much what I said, but in summary, again, You really need to know these. I am just scraping the surface on these. That was a super quick summary, and you can dive so much further into this. What we are going to focus on is the ratios and comparing these financial statements between different companies so that we can analyze them and see who is the best in their industry. That is what we're going to focus on for the next little while here. So please stay tuned. Again, my name is Zach Hartley, and thank